I'm Keith McCullough. I'm back. Fortunately or unfortunately for you, you have to put up with me, but you get somebody else to talk to now about the Fed, Danielle DiMartino Booth, who is like got it all, including the non-politically correct answer every single time.
I'm a lot less political than the Fed is, let's put it that way.
Yeah.
Which makes me non-PC.
Exactly. Well, and I saw your, I don't know if I'd call him PC or not, but the guy who used to work for Fisher on, I have to admit, I turned the mute off and I did listen to him because I love listening to him. He's just so matter of fact. He was, I can't tell if he's like anti-Fed right now or if he's supporting what the Fed's been doing.
This cannot be an easy time for him. It doesn't matter what I say. I'm unhinged, and because I was never the president of the Dallas Fed. I was his chief advisor on every aspect of the financial markets, but I was behind the curtain. Yeah. Whereas he's, a statesman. Yeah.
And at one point he was the statesman that ostensibly could have been head of the Fed.
Oh, absolutely.
So do you have to behave a certain way if you want to be the head of the Fed, and you can behave a different way after you're not the head of the Fed?
Actually, I think Richard had his eyes more on the New York Fed, which you kind of need. Well, it is. People don't understand the structure of the Fed. If Jay Powell gets run over by a train tomorrow, then the second in command at the Federal Open Market Committee is the president of the New York Fed. The vice chair of the Federal Reserve Board is more of it's not the same role. You don't have the same power as you do if you're head of the New York Fed. And who did Jay Powell bring in? He brought in John Williams, somebody who admitted in public that he had never had a Bloomberg monitor on his desk when he was head of the San Francisco Fed. And people sit there saying, I can't figure out this whole Wells Fargo scandal. And I'm like, let me tell you where to start. And that's so it was very, very odd that Powell put Williams in at the New York Fed.
Yeah. So Fisher was a candidate academic for that seat?
No, not then. This is years ago.
Point, right?
No, this is years ago when Geithner was leaving.
Yeah. So now you got, that's an interesting situation. We could talk about a lot of different things, but since you mentioned it, you have, I guess he's a Berkeley PhD. It's perfect. No Bloomberg. We don't really understand the markets, but now you have a Federal Reserve that absolutely acts on what the market's doing, and he's the head of the New York Fed,
regulating the nation's financial system. Because that is what the New York Fed does. It regulates everything on that island of Manhattan. So it's ironic to me. Williams is the one who rolled out recently with this whole idea of an average inflation. We can just let it float above, like they can get it above 2, but we can just let it float around and average out to 2%. I'm like, could you come up with a worse idea? But you'll notice that when Jay Powell tripped badly at his December the 19th press conference and said that quantitative tightening was on autopilot, that John Williams was out within 48 hours on CNBC doing damage control, and that is his role. When investors hear Jay Powell speak, listen the most. But if you want to find a second in command to listen to who's got Jay's ear, listen to John Williams, even though he really doesn't understand the markets.
We know it's really bad when SPYs are down 30, 40 handles in the morning, credit's not trading, and you have Williams scheduled to be on after Kudlow.
Yeah, these optics are, let me put it this way. People think that Jay Powell's been influenced by the Trump administration. That's the one area where I will come to his defense that's left. It's like and I founded the Jay Powell fan club when he first came to office last February. The Dow tanked 1,000 points, how many times? No press release, no nothing, no assurances, just first congressional testimony, we're not slaves to the stock market. I'm like, go Jay, go, sign up here. But that being said, there is one thing that Jay Powell is not, and that is he understands that Supreme Court precedent dictates that the head of a federal agency, which the people in Washington, D.C. are, they're government employees. Their email addresses end in .gov. So Supreme Court precedent dictates he can't be fired. And senators from Democrats and Republicans have come out and said to the Trump administration, try us. You can't get it past the Senate. We confirmed him. You can't just willy-nilly fire him for cause unless there's truly cause there.
So I mean, people are going to say it's politicized because 50% of people are going to say that anyway.
Sure,
but in the moment, maybe just to get to the what I should have asked first, which is, what do you think happened? Like, what do you think happened yesterday? What do you think has been happening? I called it I called it today. I called it going triple dovish, right? Because we have three separate times.
I mean,
but
talk about satisfying markets. So, look, August 29th, the S&P 500 hits its all-time high, and around the same time, quantitative tightening hits this run rate of about $233 billion on an annual basis. Well, that equates to a rate hike. About every $250 billion of quantitative tightening you get equates to a rate hike. Now, Powell didn't believe that, but fast forward 17 weeks, and from that August 29th high in the stock market, and the S&P, whatever it lost, stocks in America lost $4 trillion of market capitalization. Credit market, the equivalent of the Fed's balance sheet, by the way, credit markets froze solid. 41 days of no high yield bond issuance. According to Dealogic, that's the longest span since data that go back to 1995. So he has a private equity background. If you read the transcripts from 2012 and 2013, I don't get out enough. I read all of them. If you read his comments from back then, this is the man who said in October 2012, we are blowing a duration bubble across the entire credit spectrum. Those are not my words. Those are his words. So he was like, so we could have real issues when we start to tighten, issues we won't understand. And that's according to my contacts in the hedge fund world and in the private equity world. He still speaks to them. So he kind of gets the fact that, exchange traded funds lost 2 percentage points of value by the time Christmas Eve rolled around. The very structure underlying the market that is a fairly new phenomenon in a post-crisis world over the past decade was tested and failed.
Yeah. Well, that transmission mechanism to credit, which anyone who's grown up in private equity or certainly been their lawyer would be aware of. And it's kind of, my old boss is actually David Rubenstein at Carlyle.
Who hired Jay Powell.
Yes. I was shocked to see such a thing. Yes. Not really. But at the end of the day, like when I went to Carlyle in 2007, Rubenstein would be the last guy to do macro. The last guy. Like look at a guy like me, like he's, if you know him, you know. I just
micro
it is what it is. And he's the guy who would actually say, David Rubenstein, like on a plaque on his driveway in the Hamptons, is, if you're here, turn around and go back to work. Like he's that guy. He is totally anal, buttoned down, bottom up. And he also was, I think he was a lawyer, wasn't he? Originally, at least the Carlyle founders are generally of that ilk. So
as was Jay Powell,
and now
originally a lawyer.
Exactly. And now he's head of the Washington Economics Club.
Right.
And there he is, after the first dovish pivot with Carlyle.
Oh, yeah.
Transmission mechanism for private equity, issuance of new high-yield bonds or not. What are we willing to do here, Jay? I can only imagine if I am sitting there like a fly on the wall listening to these two guys talk before they get the mics on.
Oh gosh, I mean, what the true discussion was, wouldn't we have liked to have been privy to that?
Yeah.
I mean, you've got leveraged loans. I mean, they had their worst month of issuance in December since 2011. I mean, that is the lifeblood of these crazy private equity deals. I mean, they have to do these deals in the shadows, in the unregulated area of the financial system, in the shadow banking industry, because macro-prudential regulations dictate that there's some 6 times EBITDA ceiling if you do it, outside the shadows. In the conventional banking system, that's why we had the brain drain from the big banks into private equity in the current decade, because they needed to go wherever they could go to get the deals done. They didn't change the rules; they just shifted where they were doing deals from. Period.
And so while you said, I think you said that Powell's not in Trump's back pocket. He's in private equity's back pocket, isn't he?
Oh, I think he is. I think he's always been in that community, embedded in that community. I think he is also. I think he also considers himself to be part of corporate America. When he was at the Carlyle, he founded the Industrials Group. So he's talking to the president of Cummins.
Powell did?
Powell founded the Industrials Group.
I did not know this. when
he was at the Carlisle.
Really?
So he's speaking to.
I like that, the Carlisle. It's like the Ben Bernanke. It's like a thing.
When he was at the Carlisle. Yeah.
The most powerful lobby in Washington when it comes to anything that is private equity.
So he's speaking to hundreds of CEOs worldwide. He knows already that manufacturing has turned in this country. He's known it. He understands something like that. When I was advising at the Fed, if I was to waltz in with something like the Cass Freight Index and say, good God, we're down for 3 months in a row in February. We topped out in late 17 and now we're in negative territory 3 months in a row. They'd go, I don't think we've ever heard of this Cass Index. Can you seasonally adjust that data? And no, come back later on when it's established. And I'm like, we're a consumption nation here, and trucking is slowing down. So I understand that. Most people at the Fed don't want to even hear about it, but Jay Powell understands it.
Yeah, he understands it.
Yeah.
He understands rate of change. He understands slowing versus acceleration.
He's learned about the rate of change.
Yeah.
I don't think he quite understood it until he was like in the driver's seat going, oh, because
Well, that's an interesting thing for maybe people to understand as well, because you're providing tremendous context on how the actual Fed works versus what people may perceive it to work, how they articulate that they work or not. But when we bought Potomac Research, Don Cohn, former vice chair of the Fed, was part of that acquisition, and he made it very clear to me that this rate of change thing that you do, like Keith, you do. At one point, I think it was called clever, which is not always. Not always
clever, condescending, got it.
But he made it very clear, and I think it is crystal clear, that both Bernanke and Yellen were about the levels.
Oh, yes.
Not rate of change, levels. It's about the level of employment, it's about the level of inflation, it's about targeting the levels, which is probably why you said what you said about Williams, which is willy-nilly, I'm going to target this inflation level that I can't hit. But it's about the level. They really, truly don't. They don't have like how I measure in map macro, which is daily rate of change with market signals fully loaded, is not how they do it.
If you talk to a Fed insider and you say, well, you started tapering the balance sheet in October 2014, and do you think that made any difference? And then when you stop, then you reinvest it going forward. They will tell you that the only thing that mattered was the level of the balance sheet.
Right, still
maintaining the stock as opposed to the flow. And I'm like, do you know that quantitative easing is global and fungible? That liquid goes in any crevice? That's why it's liquid. Liquidity is liquid. So do you not notice that everybody else picked up the baton and went batty crazy after the Fed stopped growing its balance sheet and started its reinvestments? It's the flows that matter. And we went from the Fed's balance sheet to, in the end, what, 22 trillion and counting, since China just injected, what, 5% of its GDP into the country in January.
But these kinds of things that you would say to ranking members of the Fed, they're not going to change what they do.
No, their models tell them that stock matters, not flows.
Yeah, exactly.
Not what reality dictates.
So how do you think, so now you got a transactional head of the Fed who's commercially tied, like you said. I don't want to exaggerate it, I don't want to understate it either. He is commercially tied to the transmission mechanism that is commercial credit, corporate credit, to easy money. I don't know how else you could, and how that is funded through the public markets, how it funds private equities.
Oh, I think we know how it's funded. We know exactly how it's funded.
So this is what we have.
We know that when GE blew up on Halloween, and its stocks traded down 2.5 points in one day, which was a big one-day move for GE bonds.
Yeah, for the bonds,
We know that when the GE bonds traded down and all hell broke loose in credit, because it was only 14 days later that issuance came to a halt. So that tells us other companies started being told, you're not going to be able to do these share buybacks anymore. You're going to have to shift your focus to your balance sheet. Markets did not. Markets do not want them to shift their focus to anything. And part of reopening the credit markets has to do with the stock market. Because if you don't have, if you do shift the focus to the balance sheet, all hell's going to break loose. Because any buyers other than corporations are absent effectively from the market right now. The one thing that's holding it up. We have seen the last two, brand new Merrill Lynch report. We've seen, why are they getting rid of Merrill Lynch? I mean, that is the most asinine. Anyways, but we've seen the last 2 months of share buybacks at all-time record levels. And people are like, I don't know why the market's rebounded. And I'm like, well, I can tell. Let me get you started here.
Yeah. Well, the window is about to close because they have their blackout period.
The window's about to close.
The blackout period happens, for those of you that don't know, ahead of earnings. They can't just buy their stock the day before earnings.
Yeah, it wasn't pretty when it closed in October.
And you also seen the SEC investigating executives selling into those buybacks, which is just not shocking at all.
Well,
but again, I issue a buyback and I sell into a higher price.
I've got more nutballs on my Twitter feed who are convinced, that all this debt has financed all these share buybacks. I'm like, actually, it's mostly cash flow.
Yeah.
It's mostly pure cash flow.
Well, because we're coming off a peak U.S. economic cycle acceleration. Right. We have peak, triple peak. You have a peak acceleration in GDP growth, peak acceleration in inflation, pricing pass-through, and post-tax reform, the highest level of U.S. corporate earnings ever. So that's how you fund the buyback.
It is. But to your point about the SEC, buybacks funded by debt, they're not the boogeyman.
No.
It's because it's sanctioned insider selling. Really is what it is. That's what buybacks are.
Yeah, it's legal.
It's perfectly legal, but it's the closest thing to insider information that exists under the legal purview, and there's good reason that they re-examine that because you've got executives front running their own share buybacks by selling their own personal shares.
That's sketchy.
And pumping up their bonuses.
So again, going back to, I'm just trying to figure out how this movie might manifest into the presidential election. So you and I, we agreed to agree on who Powell is, what he does, what he's paying attention to. He all but said yesterday, GDP, my outlook's still positive, but I'll go dovish at any turn in the credit market. That's basically what he's going to do.
Yeah.
So is this a political opportunity for the other side to explain that he's basically, I mean, when you think about you can think about easy money in a lot of different ways. I can give it to the people. I can give you free student loans. I could have a jubilee. I could eliminate any concern you have as a millennial to get a mortgage. I'll give you teaser rates. I'll give it to the people, or I give it to the corporates. Republicans have it with corporates currently, and Powell is there.
So if I'm a Democratic strategist, and I'm not political.
You're not. You're not political, are you?
No, God,
you're Texan.
Right, and we can secede at any time. We're like the biggest exporting nation in the country. We're the biggest manufacturing state.
But you're not a card-carrying
we're the second biggest
Republican
manufacturer. No.
Okay.
So, but what I would say is, if I'm a Democratic strategist, and people like this Ocasio-Cortez modern monetary theory, her rise in popularity, other people of her ilk that happen to be half of Bernie Sanders' age. The attractiveness of that, I would say, wait a minute now, if Jay Powell is so open to keeping the printing presses running to make sure that Wall Street stays in business, then why shouldn't we direct his printing press to something more noble?
Bingo.
Like student loans, like universal income, all these whack ideas, but because of what Powell's doing, it's going to lay him vulnerable to those kinds of attacks. If you're a political operative who can put it in simple English.
Which wouldn't, I mean, in many cases, Trump acts like a Democrat. So, I mean, wouldn't he be interested in these goodies too? Like, the concept of a jubilee or forgiving debt at any level to Trump is probably appealing. Lower interest rates forever, free money. People disagree with me, but I think that it is going. I think the GOP surprise is going to be that Trump is going to lead with student loan forgiveness. Really?
Oh, I do.
Oh, wow, that gets a lot of votes.
Exactly. So he is. I mean, he's all about winning. He's all about making a deal, even if it's making all the millennials. And why there is already support inside the GOP for some form of student loan rationalization. Look in Australia. They don't even start collecting on your student loans until you've made a certain income.
Until you're 55.
Here, well, no, it ends up being very young, but they don't have interest running up in the background.
Yeah, exactly.
Either.
Yeah.
I mean, the way our student loan infrastructure is just crazy.
That would be a good one. If I were a socialist and I was trying to come up with the greatest scheme ever on that basis, I would say, okay, I'll give you an interest-free loan. You go to school, live large. You don't have to pay it back till you're 55, but I'll give you a pension to pay it back with.
Oh. Yuck.
Some kind of living wage.
Yeah.
So you actually never have to do anything. You just live it up.
Okay.
Yeah, wouldn't that be awesome?
Okay, now you're making me political.
I am not a, yeah, I'm not political either, but I'm definitely not a socialist.
Exactly, and the slippery slope is what people do not understand was there was something much more important that came out of Jay Powell's press conference. Okay, so he triple dovish, and he did way more than the market was anticipating. I came into the meeting, I had an interview before the meeting, and I said, look, they're expecting 0 in 19. If he wants to over-deliver, he's going to say 0 or 1 in 20, which he did.
He did.
And he tapered he drastically reduced quantitative tightening out until September, but he's making it into such a small, QT's irrelevant within a few months. But what he did, and when he was asked in the press conference where that's going to leave the balance sheet, he said, oh, somewhere around 3.5 trillion. No, it's not. It's closer to 3.8. But it's a good optics soundbite to say, you know, to suggest that they're going to be able to reduce the balance sheet by a whole $1 trillion, because then it distills the criticism of you've monetized the debt. If you admit to the fact that you cannot shrink that balance sheet, then you are saying you're going to monetize the debt. Because when he was on stage with Bernanke and Yellen and asked by the New York Times' Neil Irwin pointedly, would you pull quantitative easing out if conditions warranted, he said yes. So now you've got all the trading floors who were saying 85 billion, 100 billion, they're already making bets on what the size of monthly QE is going to be.
Oh, of course. I mean,
they're saying, can we go to 8 trillion, 9 trillion? How big can the value?
Well, it's going to be back to the level. It's going to be back to the level. The Federal Reserve ideologues have always thought that there's a certain level of the Fed's balance sheet relative to GDP, right?
And it tends to follow Goldman Sachs research.
Right. Well, there you go. Maybe use 3.5. If it's 3.8, that's an interesting point. I didn't think about that either. 3.5 is less than 20% of GDP, but if you go towards 4, you can, because I think 3.5 trillion is 17% of GDP. So you're, you know, that's a politically tolerable number. But 20 to 25%, 50% of GDP?
That's right.
50% is actually a number that the Europeans throw around, or have
well, I mean, look at the ECB, the European Central Bank's at what, 42%? Double?
42.
42.
Yeah, there you go. We have plenty of upside.
And let's see, that their effort at tapering their purchases failed within, what, a few days?
Yeah.
So it was a smaller window.
Yeah. Well, we're going to take some questions for Danielle here in a second. I still have to keep asking mine. But like you're going to, or maybe you have, and you can scare people, right, with this insider view of reality. And sometimes reality is scary. Like a lot of people say what you're saying, and they'll turn around and say, this has to end poorly. It hasn't yet.
It hasn't yet.
So, like, is that something that you're still like, you have that crowd of people who are like, wow, she actually knows, she's telling me everything that I wanted to know, it's got to end soon? Or is this actually just the beginning, Danielle? I
have no flippin' idea, because...
I have no flippin' idea. She's expanded what I said, this is day 3. I said the 3 words that people refuse to say, or I don't know. You just went to 4 words.
Woo!
Actually, it's more. I have no flippin' idea. There you go. Because we don't.
It took me a few years of post-traumatic stress after leaving the Fed. I mean, I was never a bureaucrat. I started off in an investment bank where you are what you eat. It's like, what did you produce yesterday? So
that was your first job after the Fed? At a bank?
No, before. I started at DLJ.
Okay, yeah, okay.
Back in a name that it's not even with us
anymore.
But
after the Fed, you go through this post-traumatic syndrome period.
But after the Fed, there was just a while that I was so convinced the world was going to end. And I was fighting the Fed after being inside the institution. I'm like, these people are so out of touch with reality. It's got to end. It's got to end poorly. And you know, friend of mine, Michael Hartnett at B of A Merrill, you know, he and I had...
The technician, Hartnett? The guy?
He's the head of strategy.
Okay.
And he and I met several years ago, and he's like, it really just is about the flows.
Yep.
And I'm like, I've been saying that for years, and he's like, well then, listen to yourself. He's like, you've got, because at the time, what we had 2017 was $2.12 trillion of global QE worldwide, record run rate. And how many times did the VIX close south of 10? He's like, it's just about the flows. So, when China started printing like crazy just this past January, because things are bad in China. Things are really bad in China. 3M just came out at a conference today saying things are bad in China. Things are really slowing down. The global automobile industry, which has been on a massive 15-year ride, that's been a huge prop to global manufacturing, that's slowing down. So I didn't fight Chinese authorities injecting 5% of their GDP. That would be like the equivalent of Jay Powell coming out and saying, okay, all hell's broken loose. I'm going to do $1 trillion of QE in 31 days. Done. But that's what the Chinese did.
Yeah.
And I knew that the share buyback engine was revving back up after Jay Powell, like Moses, parted the seas and said, let the capital markets reopen. So I'm like, we got share buybacks and we got the Chinese printing like madmen 24/7. Markets are going up.
Yeah.
And once I learned to stop fighting the flow, so this could go on.
Yeah, the flow is a tough one. I mean, David Zervos is very good at articulating the flow part too. I mean, he's.
But people are like, QE's going to start tomorrow, and
Yeah.
I'm like, no, you're still talking about bureaucrats.
Yeah.
The Fed is a process-oriented institution. They're not going to take interest rates to the zero bound tomorrow. There might be a 50 basis point rate cut, but that would be kind of big.
Yeah.
They've still got to stop with the quantitative tightening, A. B, reduce interest rates back down to the zero bound, B, before they get to see quantitative easing.
Yep.
Unless John Williams changes the playbook, which could happen.
Well, to me, I mean,
They could come up with a new model.
Well, I mean, cowbell is always part of the model. We know that.
More cowbell.
And we
my
go
favorite skit.
like we have. I think we got. Well, actually, the tournament. By the way, for those of you that have turned this off because the tournament just started, like. Not that I'm betting on these games, but I mean, Mississippi State cowbell.
Hey.
I get everybody. Like, I'm going to collect a bunch of these throughout this next period of whatever they do.
More cowbell.
Because all of our subscribers are like, I got to get my stuff on the show.
Yeah.
Like this stuff is just, it's incredible. But at the same time,
it is. But so I'm gonna contradict myself for just a second. The reason people don't understand the reason that quantitative easing stopped at the Fed was that we had started to monkey with the functionality of the mortgage market. And we owned 40-50% of certain QSIPs of treasuries. So we were beginning to monkey with functionality in the biggest, deepest, most liquid, risk-free market on the planet because we were buying so much. The Swiss, whatever, they buy stocks. The head of the Tokyo Stock Exchange came out and said to Kuroda, enough. Can't function anymore. You're buying so much. You had Draghi buying what became a junk bond. All I'm saying is, in theory, there's no limit to what can be purchased via QE, but in practice, it might not play out that well. And the Chinese might want to get in the way of that functionality because at some point they could feel that there's a vulnerable opening to make a play at reserve currency status.
Yeah, well, people generally forget, especially if they're just looking at the U.S., is that it's a relative game. Who's going for more cowbell faster?
Right.
I mean, to a degree, Powell, you could make the argument, and it's probably not how he thought about it, but going to the third pivot, the third dovish incrementally pivot, was based on the Europeans going finally to accepting that Italy's in a recession. They went to TLTRO.
Yep.
Dollar was up, euro was down.
Yep.
It's like this game is, the game goes on every single day.
It does.
Before we take, it's almost at the time to take some questions here. I just want to get your reaction to something. If you guys could throw up slide 68, I think. I want to go back to the transmission mechanism of earnings slowing into the credit market. I want to see if you agree, because I run this by institutional clients all the time, but I'm curious as to how somebody formerly from the Fed would react. If you go to, so slide 68 here, guys, is showing where the U.S. economy was back here when you were. I guess you'd probably be about 15 back in those days.
Yes, I was. Give or take.
5.3% economic growth. All of a sudden, and you're off this epic growth cycle. You go from 5 to 4 to 3 to 2 to 1 on U.S. GDP within 4 quarters. Next slide. S&P 500 earnings at the time go from effectively the cycle peak, which was not surprisingly the quarter after GDP peaked at 22.9%. That was the peak growth rate, peak for the stock market. So again, I'll go back to where we are today. But again, within 4 quarters, GDP didn't go into a recession. Earnings were now, within 4 quarters, down 18% year over year. And it wasn't just for a quarter, down 13, 18, 16 too. Go to the next chart, guys. You can actually go to slide 71. Credit spreads did this. They went up, head fake down, then stayed up. Stayed up is not how the current, like we've had episodic non-trending credit spread blowouts since the financial crisis. This is oil, energy, China slowing. Yep. But again, it's there, then it's not. It's there, then it's not. Is this actually possible? Is it possible to keep credit spreads wide when you have a guy at the Fed who is 100% focused on not letting that happen? Did it never happen again?
It's very difficult, but a loss of confidence would allow that to happen. I did an entire briefing for Richard when I was at the Fed that spoke about quantitative easing cutting a default rate cycle in half, plotted out a bell curve, and showed that quantitative easing had literally cut the default rate cycle in the high yield market in half. Stopped it on, and that's actually what he did by pivoting, by reopening the capital markets. All you have to do is keep the capital markets open. That's it. And then you can buy as much time as you want, and you have to have the rating agencies agree to play along ad infinitum. We already know that they're being strong-armed by management to keep these investment-grade ratings on these companies that don't begin to merit it.
Well,
this would be Armageddon.
Yeah, but it's never not happened before is the point. Every single time that earnings go negative year over year, whether it's in the 1991
and earnings
recession,
are going negative.
Yes, exactly. Go back to the slide.
I just put a graph together that basically shows what it looks like when the Cass Freight Index goes down for 3 months consecutively year over year. What happens when FedEx's earnings decline as they have, and we plotted that up against S&P 500 operating earnings, and guess what? They're on their way into negative territory.
Yeah. This is what S&P, and against these comparisons. So again, same chart, again, going back. Here are the 3 toughest comparisons because these are the 3 quarters, peak tax reform earnings, peak everything, globally synchronized recovery, fully loaded. The street, these are the Bloomberg estimates. They're at 1% next quarter, 1% the quarter after that, 2%, and then up 8%.
Up 8%, yeah.
But it's actually a trivial matter. I mean, if you take the S&P 500 EBIT margin down by 80 basis points, that'll be down 7 to 9% year over year. So that's the question is ultimately, go back to that slide 71. Unless it's different this time, why would credit spreads not widen and stay while is, like he'd have to go to rate cuts, would he not have to?
He would have to go to rate cuts, and quickly.
Yes.
And we're not talking about 25 basis point little baby steps here.
So so this is the...
But he doesn't have that much ammunition, remember.
What happens if oil's at 60 to 65, just take today's price?
Yeah.
Inflation's rising, you got late cycle labor costs rising, you got inflation rising. Would he give a damn that academically he shouldn't be raising rates in the back half of the year, or that he shouldn't be cutting rates because some people would say he should be raising rates?
I think what he showed yesterday is that he's a student of history. He was not going to repeat 1937. He is going full dove in.
So we're going to if we're both right on this, sounds like we have the same view. If we have negative earnings, Powell will have to cut interest rates in the back half of this year.
Oh, absolutely. Look, there's something else that's going on in the background that's related to those tax cuts. And that's that a lot of people in these SALT states are not getting the tax refunds that they anticipated getting.
Good point.
Fresh data just out overnight shows that Americans are not bringing their mortgages back out of arrears as they have. February and March are the sweet months for people who were 30, 60 days behind on their mortgages catching up. They take that tax refund money and they plunk it into their house. So they get caught up.
Yep.
Because they spent too much for Christmas.
Yep.
Fine.
It's their credit line.
It is. And you got news out of the automobile industry that yesterday that they're cutting production. That was not expected. Why? Because people aren't buying cars. They're not putting down payments on cars with their tax refunds because they're not getting them.
They're not getting them.
We've always had Q1 seasonal aberration, negative prints. Steve Leisman comes out on CNBC and says, don't worry, it'll disappear in the second quarter. Second quarter rebound. Second quarter consumption comes back. Why is that? Because most people who get tax refunds spend it all. 70% of our economy is consumption. Where's that consumption rebound going to be in 2019?
That's interesting. Really interesting. Yeah, SALT has so many far-reaching impacts. I guess that's the data as of last night.
Yeah.
Cool. All right, now that we've fired some people up about this, we have probably 10
now they're really scared.
This is crazy. I can't ask the craziest question first. I will get crazier because, as you know, we're not crazy, but we will take the questions. Going with the flow is a great idea, but don't you think we eventually reach a waterfall of hyperinflation? I get that question a lot.
And that question is viable, but that question only comes into play. And look, the world's not going to end. It's not. Mm-hmm. But hyperinflation means that U.S. Treasury auctions are boycotted. Mm-hmm. That's the implication. Under what scenario would that happen? I mean, the euro would probably be gone.
Well, people also forget the flow of that trade. If the world is going to hell in a handbasket, you flow into treasuries and dollars.
Of course you do.
The whole point, right?
And the float of some of these treasury bonds are not what people think they are.
Right.
People are like, nobody's going to be buying the 10 to 30. I'm like, check out what the float is and compare it to something like Amazon.
I don't know if you know Danielle DiMartino or not, the Spanish economist. His answer was, we already have hyperinflation, but it's in asset prices. Yeah.
And that's why, it's interesting because Bill Dudley's last act as second in command at the New York Fed was to create a new inflation measure.
Yeah.
And which Washington, D.C. said, gee, it's been sitting around 3% for a long time. Thank you for your hard work and enjoy your retirement. And that's that, because there was an inflation gauge that was way above the 2% target for a very long time that took into consideration real estate prices and asset prices. And they're like, that doesn't work.
Yeah.
Moving on.
I love this. Your Texas reactions are priceless. They should have a Canadian and a Texan run the Fed.
They should.
Then the world would actually.
Canadians don't have to secede, and Texas can. So we're completely agnostic to whatever's going on in between those two borders.
Here's one. Interesting comment, Danielle, with the rating agencies. So now people are going to start to go a little conspiracy theory here. With the Fed on corporate debt ratings. Question, do you see any concrete evidence of corporate managements working in concert with rating agencies to avoid having lower investment grade corporates get downgraded to non-investment grade junk?
No, I don't, but if I find it, I'm going on 60 Minutes. And it's going to be so exciting. Actually, to answer your question, I have actually spoken to people who have left the rating agency because of the pressure to maintain the ratings. Yeah. I'm talking about former rating agency employees.
Oh, I believe that.
In the high yield area.
We're talking about it, not to offend them, but relative to my research team, certainly, they're kind of like the Bush, they're the B League, right? These analysts at rating agencies, they're not high-paying jobs.
And there's a massive Chinese wall in between management and the analysts. It's just incredible the pressure these people are put under, the operatives that they're given, and how far removed they actually are.
Yeah, I mean,
and yet they have to maintain these investment grade ratings.
It's crazy. Actually, I mean, one of the more disappointing things that Buffett's ever done to me, he's done a couple things, but I'm sure he doesn't care about us, but how could we disappoint him? But when he said, how could the rating agencies have known? They couldn't have known, because he owned the stock. I mean, it was like, give me a break. I mean, this is ridiculous.
I mean, look, the triple B thing is all I can say about triple B, because I've written extensively about it. I understand it.
It's a big topic.
It's a huge topic, but you know what? The junk bond market's a little starved for paper.
Yeah, big time.
So it wouldn't be such a bad thing, relatively speaking, contained if there was some more paper to go around the junk bond universe. If you look at your typical junk bond ETF, 20% of the holdings trade. The other 80% of the holdings trade by appointment. Mm-hmm. That's a bigger problem than some fallen angel.
Yeah. One, the bull case to this is more of a case, I think, on Mix. So I can't name his name, but he's one of the top three asset management firms in the world, runs a ton of cross asset class money, including fixed income. And he's like, okay, triple B, I get it. That's a waterfall. If GE is the fulcrum point, boom, all this other stuff.
GE was 111, AT&T is 181 billion.
But he's like, and there is a component of it's different this time. Nowadays, and again, a lot of this is on the backward-looking point of when you get the all-time high in profits.
Yes.
A lot of companies look good. They look like they're never going to have a problem.
Sure.
So when he says, when you look at the mix of corporate credit today versus the mix in prior peak cycle, pro-cyclical peaks in corporate credit, it's much healthier. And that's why it's good to be a credit picker, I think is what he would call it.
Okay.
But I said to him, I don't know, man. If credit spreads widen we went to 500 over and the market stopped trading. 500 over, right? That's actually, as you can see there on this, it's the historical mean. But back in here, we could be 800 to 1,000 basis points over. I mean, I'm pretty sure the whole asset class is going to trade with at least a cold, maybe some dry heaving flu. It's going to,
remember, the most important objective of quantitative easing is to make sure that the refinancing wall never manifests, is to make sure that you constantly move the refinancing wall down. If this happens, $1 trillion of the $10 trillion corporate bond market is in trouble quickly.
Yeah.
If your earnings recession manifests the way you're describing, 1/10 of the $10 trillion bond universe is in trouble quickly because their cash flow's so skinny compared to their obligations.
Yeah, exactly. Well, and again, imagine that. The credit spread.
This was in The Economist. God, when something's in The Economist, that means that it's like, whatever, person of the year who's then like, going to jail the next year. It's like, if it's in The Economist, it's like, boy, that's water under the bridge.
All right, keep the questions coming. Going to Danielle's comments about SALT tax investors are not getting refunds. Got calls from 2 clients about this in the last 2 days, and their taxes due are actually up substantially. Is that? I guess that would make sense. I mean, your taxes due are up.
Taxes due would be up.
Yeah.
I mean, you're capped at $10,000. So, and again, there are 2 chapters to this story. There are, because I've spoken to a good buddy of mine as a CPA in New Jersey, and I mean the anecdotes that he was sending me. But more to the point, in the very beginning, the very first day that you can go out and electronically, you take a little hickey, but electronically get your tax refund.
Yeah.
That's chapter 1.
Yeah.
Those people have already, either somebody said, okay, you have to, we're going to push send, but you have to have this much money. And then, wait a minute, where's my refund? No, you actually owe taxes. So that oh no moment has come and gone. The second chapter is when people have to pay their taxes and what they have to spend is that much more. Look, people in the top 20% of income earners account for, 60% of consumption? You're talking about a lot of them in these SALT states who are going to have bigger tax bills, and they're also not going to be spending money. They're going to take a Disney cruise instead of going to Tahiti.
Well, people actually forget that point too. I mean, it's pretty easy to show. I wish I had the chart, but if the top 20% of Americans in terms of income earners are going to constitute 80% of consumer spending. And they're highly dependent on the path of stocks and earnings.
Right.
They own the companies, or they get paid by the companies. People that have a lot of money either own one or they work for one in the S&P 500 that overpays them, or pays them a lot, whatever, underpays, overpays. And when the stock market gets its rear end handed to them, and then they get tacked on SALT taxes, and now they have flood insurance that's changing. I don't know if you've seen that. What do they call it? The NIHP, National Flood Insurance.
Okay.
Is basically you got all private insurance wants to start to impact with their kind of CAT ratings on. They want to reconstitute what the geographies and what your actual flood insurance premiums could be. So now you're a rich person with a place on the water, and okay, wow, I got this one. I got premiums up 5 to 10 grand. There's a lot of money that's starting to add up here on the margins. That
theme is something that I don't think enough people understand and appreciate. If you broaden that theme out to demographics and baby boomers and the amount of real estate holdings that they have, and the fact that a lot of them are going to be looking to sell their second homes, especially when these moments occur, and we're seeing real estate turn, and we know that the high-end real estate market is just closed for business. But if there's other costs associated with these second homes, and then you've got high-end real estate already in the garbage, what happens when they actually want to start to sell their homes, the baby boomers? Because the millennials are just now buying entry homes. So there's going to be this great big vacuum in between, because where's the move-up market? Nowhere. Not with millennials just now making babies. There's no move-up market. They're just now buying their first home. And baby boomers are selling, so there's a middle. And the price declines at the high end are going to be nothing like what anybody's expecting.
Well, that'll be interesting to see that asset deflation. I mean, at the actual asset that's the biggest on the household balance sheet.
Here I am in Connecticut. Schiller said a few days ago on TV, he was like, it's great that we can say that it's not as bubbly as it was headed into '05. He's like, but outside of 1890, this is the third largest real estate bubble in U.S. history. And I'm like, everybody's got the mute button on. Nobody's nobody's listening to Bob. It's okay.
The year 1890. Yeah, the year 1890. Actually, it was the first, because I was actually in the econ department at Yale. And I was like, this is the first dude that actually makes some sense. Because he wasn't talking about like these magically linear curves. And what he was just showing was mean reversion. And all of his charts, to your point, they go back to like the 16th century.
Oh, yeah.
And he's just like, whoa, look, it goes up, and then it comes down, and then it goes up. And I was like, holy, this is the first class at Yale I've understood. This is actually...
And he looks at earnings the same way. He looks at residential real estate prices.
Yeah, mean reversion. It's macro 101. Shit mean reverts. I mean, and it was this moment for me. I was like, wow, I could really apply this to my internship in the stock market. And lo and behold, you look at a lot of charts, macro, and they're all mean reverting. Anyway, that's a bit of a tangent. But people really do not pay attention to the long cycle. They're like, here's my macro tourist data point of the day. What's that going to do to stocks today? You know, to put it within the context of a long-term earnings cycle.
I mean, look, in the app. Okay, so what's the encore now going to be?
Well, I think you pointed out. I mean,
you can't recreate subprime mortgages.
We're going to have something, a bag of goodies for students and millennials, and they're going to be associated with getting the votes.
I think that's so bipartisan. It's a shoo-in.
Let's see here. Interesting take on rates, Danielle. But isn't this just all a global chase for yield? Even the Greeks floated 10 years at 3.67% 2 weeks ago.
Well, this chase for yield has no end. I mean, the German Bund was what, at 3.5 basis points? I mean, they're negative out to 9 years. Yes, there is a continued chase for yield. Yeah,
that's I call it the sword of Damocles over the U.S. 10-year yield is just global rates. I mean, this morning the Swiss 10-year is
minus 40 basis points.
There's
not very much of it, of the 10-year, float-wise. So look, people are like, oh, the dollar's going to crash, and I'm like, because what's going to displace it this year? I get that we're easing.
It's supposed to be crypto. Remember that?
Oh yeah. No. I don't talk about that because then the Twitter thing goes. No. I keep them off.
You weren't on the wrong side of that.
No. Gosh, no.
But there was actually a pretty long list of people that were on the wrong side of that.
Okay, but if you're talking about Shiller and long-term charts, all I had to see was like, this thing's bigger than tulips. And I'm like, got it. Okay, that was like my very first economics course, bigger than tulips. Let's move on.
Here's another one. Can you comment on the divergence between the 10-year yield and the S&P 500? What does this divergence tell you, if anything at all?
That risky asset prices like low interest rates? Wait, was that a test? Was that you or somebody asking the question?
I'm just asking the question.
Yes, no, risky asset prices do like low interest rates because then you can keep getting more credit.
Hey, you're getting good at this. You're getting really good at these questions here. Keep these questions coming. You guys got to get some that are a little bit more unique relative to the ones I've asked. Isn't the only real limit to the quantity of central bank printing related to the risk of mass social unrest, which would most likely be due to the runaway inflation of things that matter, like food, energy, housing, which seem to be a long way off? I don't know, what do you think about that?
Well, I think it's a long way off, relatively speaking. Remember, it's baby boomers. The last time we went into crisis, baby boomers had optionality. Pension fund managers had optionality. The baby boomers said, you know, 50 is the new 60, 60 is the new 40, whatever. They were all able to stay in the workforce. And we know by looking at the data that they have. This has been a consistently growing demographic, people north of 55 flowing into the workforce. So they had that optionality. But they are 10 years older. And then public pension fund managers also had optionality. Because back when the market melted down last time, all of their assumptions were actuarial in nature. All of their assumptions were accounting assumptions. Right now they have this thing called cash flow because there's actual retirees who are collecting money. And that was, I think, the other thing that really, it wasn't just the freeze in the credit markets. It was somebody saying, Mr. Powell, the average public pension lost 9% in the fourth quarter of 2018, and we think that this could be problematic for the state of Illinois for starters. Because you could see the mushroom cloud over the Willis Tower. So, because there's nothing that can be done. I mean, right? I mean, the Constitution says that the state of Illinois cannot declare bankruptcy. So, so there are, demographics is something that should not be ignored because baby boomers are now collecting cash payments. And last I checked, the Fed can't buy munis, but I'm sure it would I'm sure Congress would pass some law that allowed them to come in and prop up the whole municipal bond market, which why would anybody be buying Illinois paper otherwise?
Yeah, no, exactly. Now, since you mentioned it, I mean, now people are asking us about old ladies and having no return on their savings, and students who have no way to return the principal on their student loans. And he actually said, can we hook them up? It's crazy out there. Why not?
They are hooked up.
Yeah.
They're not unhooked up. Look, this
well, the old man or old lady who has a savings account who's earning nothing is not getting hooked up. That person's not getting hooked up. Well, the student with a lot of leverage is getting hooked up.
Okay, so here's how it works.
I think.
So the parents are on the main floor. This totally kills my baby boomers have to sell the house theory. They don't have to sell the house.
Who's on the main floor?
The parents.
The parents, right.
The boomer's on the main floor. The child is in the basement.
Playing Fortnite.
Saying, God, I hope they pass that universal basic income thing so I don't ever have to move off my ass. I didn't say that. But upstairs, she's just a mom. But for God's sake, it's time to be a grandmother.
Yeah.
So how am I going to fix this? I want to buy nappies, for God's sake. How am I going to rectify the situation? And the kid in the basement says, I'll move up top. I'll get married. I'll have kids.
Yep.
And that flip, that demographic flip, I think we will see increasingly the Italianization of the American family, where you've got multiple generations under one roof because the younger generation could not afford to go out on their own and buy the house. But you've got all these baby boomers with McMansions and 6,000 square feet that grandma and grandpa can easily just go quietly be in the basement and finally get their grandkids.
Or they go like in my in-laws, my father-in-law is an Argentine, and they call the Argentine, they don't call him grandpa, they call him apapa. Because Apapa lives upstairs.
Oh,
so
there
the
you
parents
go.
live. So that's where you put Apapa, especially if the kids are playing Fortnite in the basement.
In the basement.
So you have actually that's the whole point.
Yeah.
Is that these boomers, particularly if they don't have any retirement or pension earnings
today. That's before the stock market crashes.
Exactly.
But yes.
Yeah. No. I mean, it's kind of a crazy thing that you can already see it happening in terms of how the movement of life is relative to this big, bulge of baby boomers that are coming into that age. But
there is a solution. It's just not a conventional American solution as we would think about it.
Right. No, it's South American. It's European. That's why I used Italy. I used Argentina. I mean,
but it's coming.
Yeah, and these are bankrupt countries.
But think about what that does to residential real estate construction.
Oh boy, not good. I guess last question here. Let's ask. Actually, you know what? I think we got most of the good stuff in there.
Okay.
But
thank you for the no crazies.
Yeah, thank you. Yeah, I can't get it. I know people are going a little crazy in the queue, but thanks for going crazy in the queue. But thank you for your just being completely open and forthright about most of these topics. I think for a lot of people, these topics are obscure, inaccessible. They can't get on the inside of it because they've never been there. There's a lot of emotions that people have associated with these topics, and you kind of tone it down for them. You're like, hey, look, think about it with common sense.
Sure.
And I think that's
you want to own the rally. I get that you want to say that these gains are permanent. I get it. But what you circle when it comes to earnings coming down, there's nothing that you or I can do to touch that.
You're making people kind of sober up about the whole situation. So thanks for doing that.
Absolutely.
All right. Thanks for coming in.